Today, we're diving into one of the gutsiest bets happening in the American trucking industry right now. We're talking about a high-stakes, high-risk strategy that could either launch a company into the stratosphere or, become a massive cautionary tale. All right, let's get into it.
So here's the big question at the very heart of this story. It's a classic business dilemma, right? But you rarely see it play out on this kind of scale, with billions of dollars and the entire future of a public company hanging in the balance.
And this is our main character, Saia, a big name in the LTL, or less-than-truckload, shipping world. Now, these guys aren't just dipping their toes in the water here. They've absolutely cannonballed into a huge strategic gamble, and we're going to break down exactly what that means for the company and for anyone investing in it.
Okay, so what is this big gamble? Well, at its core, Saia is deliberately, and I mean consciously, deciding to make less money right now. They're taking a hit to their short-term profits in a really bold play to snatch up a much bigger piece of the market for the long run. But to really get what's happening, you got to understand how these companies keep score. This right here, this is the single most important number for this entire story, the operating ratio, or OR. Honestly, just think of it like a golf score for a trucking company. The lower the number, the better you are doing. It tells you how many cents of every dollar you earn get eaten up by costs. So a low OR means you are an efficient, profit-making machine. A high OR, well, that means you've got problems. Just remember that. Lower is better. It's their entire report card. Now, Saia didn't just wake up one day and decide to do this in a vacuum. No, a massive industry-shaking event went down that basically blew the doors of opportunity wide open for them.
In the summer of 2023, a true giant of the industry fell. Yellow Corporation, a company that had been around for nearly a century and was the third biggest player in the whole game, just went under. And this wasn't some small ripple. It was a tidal wave that crashed across the entire U.S. shipping network.
Just think about that for a second. 10% of all the capacity for shipping goods this way in the entire country just disappeared. Overnight, all of Yellow's customers, thousands of businesses were suddenly left scrambling, desperate to find anyone to move their freight. For the company still standing, like Saia, this was a once-in-a-generation moment.
And Saia's response to this chaos? Well, it was anything but shy. They saw their chance to completely change their spot in the market and, man, they went all in.
And this just shows you the insane speed and scale of their move. The moment Yellow went down, Saia started snapping up their old terminals and real estate. In 2024, they dropped over $1 billion on capital spending, opening new facilities at a truly blistering pace. And they're not done. They are transforming themselves from a strong regional company into a true coast-to-coast national powerhouse.
But as you can imagine, a land grab this huge does not come cheap. And when you look at the financial reports, you can see the immediate and pretty painful cost of this hypergrowth strategy. Let's just run through the numbers real quick to see the impact. First, the investment, over $1 billion in CapEx in a single year. To put that in perspective, that's more than double what they spent the year before. Just a fire hose of cash going into building out this bigger network. And hey, on the surface, it looks like it's working, right? Revenue jumped over 11%. They opened the doors and all those customers left stranded by Yellow started pouring in. So the top-line growth, it's definitely there. But that growth came at a serious cost. So what happened to their actual profits? And this is where you feel the pain. Remember that operating ratio, where lower is better? Well, it went the wrong way. It climbed from a really strong 84% to almost 88%. And that's the tough part of the strategy. Opening all these new truck terminals is crazy expensive up front, and they aren't very efficient until you fill them up with freight, which, of course, takes time. And here is the punch to the gut. The bottom line, net income, the actual profit, it fell by $72 million. So let's be super clear. Revenue is up, but profits are down. This is the calculated sacrifice. This is the dip in what investors call the J-curve. And the billion-dollar question is it going to curve back up? Which, of course, brings us to the bull case. From an investor's point of view, this is where the gamble could really pay off. What does winning actually look like if Saia can pull this off? To really get Saia's strategy, you have to put it side by side with the industry's gold standard, Old Dominion. ODFL is known for being disciplined, cautious, and having the best profits in the business. They saw the Yellow collapse and basically chose to be patient and protect their margins. Saia did the polar opposite. And this isn't just about tactics, it's a totally different philosophy on how you build a company.
So, how is the stock market reacting to this gamble? This table's really fascinating.
If you look at a common valuation metric like the PE ratio, Saia, at 28, is being valued way closer to the super premium Old Dominion than it is to another peer like ArcBest. What that means is investors are already pricing the stock as if the bet is going to pay off. They're giving Saia credit for future success today.
So what does that success actually look like? Well, here's the roadmap. First, all those new, inefficient terminals start to mature and actually turn a profit. Then, as more and more freight fills that bigger network, that operating ratio starts dropping. A lot. That creates a bigger, better network that wins even more customers. And finally, the end game. Saia starts to close that big profitability gap with the best in the business. That's the grand vision.
And all of this brings us to the core conflict, right? To the decision that any investor has to make if they're looking at this company right now.
Of course, if you ask management, they are supremely confident. The CEO says they're just in the early innings here. He doesn't see this as the end of a big project, but as just the very beginning of unlocking what the company can truly become. They've made their bet, and they are sticking to it.
And that's really the crux of it for anyone looking at this stock. You're balancing two powerful opposing forces. On one side, you've got the very real, tangible risk that they just can't pull it off, that they can't manage this huge new network efficiently. The execution risk is massive. But on the other side, you have the potential for an incredible reward if they succeed.
And that's where we have to leave it. The stock market, for now, has placed its bet. It's pricing Saia for a win, but in the high-stakes world of logistics, a great plan is only as good as its execution. The only question that matters now is, will management deliver? Will this billion-dollar gamble actually pay off?